Something big is happening in the gold market right now, and most people haven't noticed it yet. Because while headlines are still talking about gold near record highs, and while retail investors are still debating whether it's too late to buy, smart money has already started to move. Quietly, strategically. And if you understand what's happening inside gold ETFs right now, you'll realize this isn't just another normal pullback or consolidation phase. This is a shift. And before we break this down further, if you want to stay ahead of moves like this and get the latest gold and silver updates in real time, make sure you subscribe to Gold Silver Updateds so you don't miss what comes next. Because what we're about to talk about could completely change how you look at the gold market. Right now, most people are still focused on price. They're watching the charts. They're reacting to headlines. They're asking the same question over and over again. Is gold going higher, or is this the top? But here's the problem with that thinking. By the time price tells you the full story, it's already too late. Because price is the result, not the cause. And if you really want to understand where gold is going next, you need to look at what's happening beneath the surface. You need to look at flows, at positioning, at behavior. And one of the clearest places to see that is in gold ETFs. Now, here's why that matters so much. Gold ETFs are not just passive investment tools. They are one of the primary ways institutions, hedge funds, and large capital allocate money into gold. When they want exposure quickly, when they want liquidity, when they want scale, they use ETFs. So when money starts flowing into these funds, it's not random, it's a signal. And earlier this year, that signal was loud, very loud. Billions of dollars were pouring into gold ETFs, week after week, month after month. And that kind of consistent inflow doesn't happen by accident. It happens when large players are positioning for something bigger than just a short-term trade. And that's exactly what we saw. Gold surged, momentum built, sentiment turned extremely bullish. And for a while, it felt like nothing could stop it. But then, something changed. Not in price, at least not immediately, but in behavior. The inflows didn't just slow slightly, they dropped, sharply. Now this is where things get interesting. Because most retail investors look at that and think, that's it, the trend is over. But that's not how smart money operates. Institutions don't just flip from buying aggressively to abandoning an asset overnight. They transition, they adjust, they rebalance. And that's what we're starting to see right now. This is not panic. This is not fear. This is control, calculated movement. Because when you've already accumulated a large position, you don't need to keep chasing price higher. You step back, you observe, you let the market come to you. And that's exactly what this slowdown in ETF inflows is telling us. Smart money is no longer in aggressive accumulation mode. But they're also not exiting, they're pausing. And that pause is where opportunity begins to form. Because markets don't move in straight lines, they move in waves. Impulse, then consolidation. Expansion, then reset. And right now, gold looks like it's entering that reset phase. Now here's why this matters more than most people realize. During these phases, weak hands get shaken out. Impatient investors lose confidence, and the narrative starts to shift. You'll begin to hear things like, gold has topped, the rally is over, better opportunities are elsewhere. But behind the scenes, that's often when stronger hands are preparing for the next move. Because they understand something most people don't. The absence of aggressive buying does not mean the absence of demand. It simply means the strategy has changed. And this is where ETF flows become incredibly powerful as a tool. They allow you to see that shift in real time, not after the fact, not once it's obvious, but while it's happening. And right now, they're telling us that the gold market is transitioning, not ending, not collapsing, transitioning. Which brings us to the most important question: what comes next? Are we setting up for another explosive move higher? Or is the market preparing for a deeper correction that catches everyone off guard? Because the answer to that question is hidden in what smart money does next. To really understand what's happening next, you need to go one level deeper. Because ETF flows alone don't tell the full story. They tell you that something is changing, but not always why. And right now, the why is where things start to get very interesting. Because when you step back and look at the bigger picture, you realize this shift isn't happening in isolation. It's happening at the same time as several major forces in the global economy are starting to collide. Interest rates, the US dollar, global liquidity, and investor positioning across multiple asset classes. Now think about this for a second. Gold had an incredible run. Momentum was strong. Sentiment was extremely bullish. And ETF inflows were confirming that large capital was fully engaged. But markets don't reward crowded trades forever. At some point, they pause. They rebalance. They force participants to question their positions. And that's exactly where we are right now. Because while gold is still holding at elevated levels, the easy part of the move is already behind us. The phase where everyone was rushing in, that phase is over. Now we're entering a more complex environment, an environment where positioning matters more than hype,
where timing matters more than emotion, and where smart money starts to separate itself from the crowd. Now here's something most people don't realize. When ETF inflows slow down, it doesn't just mean less buying. It often means capital is being redirected. Not necessarily out of gold entirely, but into other opportunities that look more attractive in the short term. And recently, we've started to see signs of that. Some capital rotating back into equities, some moving into cash, waiting for clearer signals, and some likely shifting into other commodities or assets that haven't moved as much yet. This is classic behavior, because institutions are always looking for relative value. They're not loyal to one asset, they're loyal to opportunity. So after a strong gold rally, it makes sense for them to step back and ask, where's the next best move? And until that answer becomes clear, they reduce aggressive buying. They manage risk. They wait. Now at the same time, another key factor is influencing this shift, and that's the US dollar. Because gold and the dollar have a very important relationship. When the dollar strengthens, gold often faces pressure. When the dollar weakens, gold tends to rise. And recently, we've seen moments of dollar strength returning. Not consistently, but enough to create hesitation in the gold market. And that hesitation shows up in ETF flows. Because large investors are highly sensitive to currency movements. They're not just trading gold, they're trading gold in the context of the entire global financial system. So when the dollar starts to stabilize or strengthen, it changes the risk-reward calculation, even slightly. And that's often enough to slow down inflows. Now add one more layer to this, interest rates. Because gold, unlike bonds or savings accounts, doesn't generate yield. So when interest rates are high, holding gold has an opportunity cost. And even the expectation of future rate decisions can impact behavior. Right now, the market is still trying to figure out what central banks will do next. Will rates stay higher for longer? Will cuts come sooner than expected? Or will uncertainty continue? And during periods like this, smart money doesn't go all in. They become more selective, more cautious, more strategic. Which again, explains why ETF inflows are cooling. Not because gold is weak, but because the environment is shifting. And in shifting environments, positioning becomes everything. Now here's the key takeaway you need to understand. This phase is not about chasing momentum. It's about reading the market correctly. Because when aggressive inflows return, they don't come quietly, they come fast. They come with conviction, and they often catch people off guard. But until that happens, this current phase is where the groundwork is being laid, where the next move is being prepared. And the only question is, will you recognize it early or react to it late? Now here's where the story takes a turn that most retail investors completely overlook. Because while ETF flows are slowing down, another major force in the gold market hasn't slowed down at all. In fact, it's doing the exact opposite. Central banks are still buying. Quietly, consistently, and at a scale that most people don't fully appreciate. Now think about what that means for a second. On one side, you have ETF investors, fast money, capital that moves in and out depending on momentum, sentiment, and short-term macro signals. And on the other side, you have central banks, slow money, strategic money, money that doesn't care about short-term price swings, money that is positioning for years, even decades. And right now, these two forces are moving at different speeds. ETF demand has cooled, but central bank demand is still there, still steady, still accumulating. And that creates a very powerful foundation under the gold market. Because even if speculative demand pauses, long-term demand hasn't disappeared. It's still building, layer by layer. Now here's why this matters more than anything else we've discussed so far. Because markets often transition between phases, and one of the most important transitions is the shift from fast money dominance to strong hands accumulation. During the early stages of a rally, you usually see fast money leading the move. Momentum traders, ETF inflows, speculative positioning. Everything moves quickly. Prices rise aggressively.
But eventually, that phase slows down, not because the story is over, but because the easy gains have already been made. And that's when strong hands take over. More patient buyers, more strategic positioning, less noise, but stronger conviction. And that's exactly what this current environment looks like. The fast money wave has cooled,
But the foundation underneath the market is still being built. Now combine that with everything else happening globally, massive debt levels continuing to rise, ongoing geopolitical uncertainty, shifts in global power dynamics, and increasing questions about long-term currency stability. All of these factors continue to support gold, not as a trade, but as a strategic asset. And that's why central banks are not slowing down. Because for them, gold is not about timing the market. It's about protecting reserves, diversifying risk, and preparing for a world where financial stability is less certain. So even if ETF flows fluctuate, that underlying demand remains. And historically, that's what gives gold its resilience. Now, here's where things get really interesting. Because when ETF demand eventually returns, it doesn't come back into an empty market. It comes back into a market that already has strong foundational support. And that's when moves can become explosive, because you get both forces aligning again. Fast money and strong hands. Short-term momentum and long-term accumulation. And when those two combine, that's when gold doesn't just move, it accelerates. Now the big question is, when does that happen? Because timing that shift is where the real opportunity lies. And the answer isn't random. It's tied to catalysts, events, moments that change how investors see risk. Because at the end of the day, gold is not just reacting to data, it's reacting to perception, to fear, to confidence. And right now, that perception is still evolving, which means the next move hasn't fully revealed itself yet. But the setup is already forming. Now let's bring everything together, because this is where things start to matter the most. Up to this point, we've talked about ETF flows slowing down, smart money stepping back, and central banks continuing to accumulate in the background. But what does all of this actually mean for the price of gold moving forward? Because at the end of the day, that's what everyone wants to know. Is gold about to explode higher again? Or is a deeper correction coming first? Now here's the reality most people don't like to hear. Markets don't give clear answers in advance. They give signals, and it's your job to interpret those signals correctly. Right now, the signal we're seeing is not extreme bullish momentum, and it's not extreme bearish pressure either. It's something in between, a transition phase. And in phases like this, there are usually two main paths the market can take. The first path, gold enters a consolidation period. Price starts moving sideways, volatility begins to compress, and the market takes time to digest the massive gains it has already made. Now this might sound boring, but this is actually one of the healthiest things that can happen after a strong rally, because it allows the market to reset without breaking the overall trend. It gives institutions time to reposition, it gives new buyers a chance to enter, and it slowly rebuilds momentum for the next move higher. In this scenario, ETF inflows don't disappear completely, they just remain slower, more selective, more strategic. And then, when the right catalyst appears, they return, strongly. The second path is a deeper correction. Not a crash, but a meaningful pullback. Something that shakes confidence, something that forces weak hands out of the market, and something that creates fear headlines again. Now, this is the scenario most retail investors fear. But here's the truth. This is often where the biggest opportunities are created. Because corrections reset everything. They reset sentiment, they reset positioning, and most importantly, they allow smart money to re-enter at better prices. Now think about this. If you're managing billions of dollars, would you prefer to keep buying after a huge rally, or wait for a pullback that gives you better value? Exactly. And that's why corrections are not the enemy. They're part of the process. Now here's the key detail you need to focus on. The current slowdown in ETF inflows does not yet confirm which path we're taking. It simply tells us we are no longer in the aggressive expansion phase. We are in the decision phase, the phase where the market decides its next direction. And this is where catalysts become everything, because something will eventually push gold out of this phase. It could be a sudden shift in interest rate expectations. It could be a sharp move in the US dollar. It could be geopolitical escalation that drives safe haven demand. Or it could even be stress in the financial system that sends investors rushing back into gold. And when that catalyst hits, ETF flows will react fast.
Because institutional capital doesn't move slowly when conviction returns. It moves aggressively. And that's when you start seeing those powerful moves again. The kind that most people end up chasing too late. So the real question you should be asking right now is not, is gold going up tomorrow? The real question is, what signal will confirm the next major move? Because once that signal appears, the window to position early starts closing. And that's the difference between reacting and being prepared.